you can't be everything, right? You can't be the gas and the brake, generally speaking, right? And so you can't the visionary also needs to be supported by the controller, right? By someone who has the organizational skills and who has the capacity to really implement what you mentioned, which is the the SOPs and the controls, right? Building out the processes and things like that. So I really had no idea kind of the step by step as far as how to build all that out. And fortunately, I've been lucky enough to surround myself with a fantastic team who have the property management experience and the asset management experience and the finance side of things. So we've been able to put those processes together. But yeah, it wasn't, I had the vision, but I didn't have the clarity of vision at the beginning.
One thing that I keep noticing is that you're a bit like me. You keep trying to figure stuff out on your own, right? And I've done this for years, and it's so tedious. Like it takes so long. I was curious to see what would you have done differently going back to the beginning when you got into the business, and you're like, I didn't even know I didn't know. Like obviously you learn so much, and I learned so much through all my mistakes. But now in hindsight, uh, mistakes are good because you learn from them, but the avoidable ones, why don't I avoid some of those avoidable mistakes? And I'm just curious to see what you would have done differently if you had could speak to your younger self.
Sure. Yeah, I think there's some stuff that, and always hindsight is 2020, right? So it's so much easier looking back. But when you're getting started in anything that you're passionate about, there's this, strong desire for action, and I just want to get started now. I just want results now. And especially when you're younger, and I think it's really valuable to have a bit more patience and really double check things and get get reference checks. And if you're thinking about partnering with somebody, or you're thinking about borrowing money from a certain lender, or partnering with a certain management company, it helps to just, spend a little more time doing due diligence. So trust but verify, be a little patient. You don't have to buy the first deal you see. So I think those sorts of things really help balance out the excitement and ambition. So that's kind of number one. On a more practical level, I would say, and this is honestly true of almost every single person who gets into real estate. You you buy in a neighborhood that you later regret buying in. And it's because when you first get into real estate, you've heard it a million times. You've heard how important location is, right? We all know location, location, location is the number one rule of real estate, but you don't really know the challenges of owning in a tougher area until you live through it. And so I think it'd be nice to just fast forward through that, right? It'd be nice if you could have skipped over those 3,000 flips and just go right to the big stuff. But same thing, everyone who gets in multifamily, they generally start by buying a Class C asset. Why? Because it's a little bit cheaper and the returns look a little bit better on the spreadsheet, but you're signing up for a whole ton more work. The tenants trash the property more. There's more move outs every single month. There's more delinquency. There's more crime. So there's just a ton more to deal with. It's a good way to learn, but it's very, very challenging. And often the risk is not worth the reward from an investment perspective. Similarly, debt. Debt is also another way where the more you use, the more attractive the numbers look on the spreadsheet. But in practice, in principle, debt, as we all know, cuts both ways. And so I think that some of the most fantastic outcomes are achieved with high leverage, right? You hear the stories. You hear, oh, wow, this person, they put 100 grand into this deal and it's 300 grand in 2 years. That's incredible. Well, the way they did that was frankly by taking a ton of risk, and it worked out, which is great. But it's really not fun when you take a lot of risk and it doesn't work out. And that's where using actually less debt comes into play. The challenge is I could share this concept till I'm blue in the face, but people who get started, including myself, are very rarely going to take the advice because it's so difficult to do so. Because if you take less debt on a project, where's the difference coming from? It's coming from equity. Now that's more equity you have to raise. We all know that when you're getting started, raising money is already the hardest thing. So it's really, there's no easy answer here, but I would say those lessons would be just incredible to take to the past. Patience, less leverage, and prioritizing location.
Yeah, a lot of lessons learned there. Now you talked about you always wanted to scale, you had the vision, but you didn't really have necessarily the team early on. I think it's a challenge when you first get started, right? Because The only thing you have to have you really have in the beginning is equity. You can throw equity around by bringing on partners. You don't really have necessarily the income to afford to hire people. How did you overcome that? So when you first got started, how were you able to afford bringing on those first? Well, first of all, who did you bring on first? Like, what was your order? Did you partner your way there? So a combination of partnering and hiring. How did that growth happen in the early days when income was limited?
Yeah, very good point. So, starting out, I had a business partner. So, you talked about you can throw around equity, right? So, starting out, I had a business partner who I was able to partner with, obviously, by sharing in the equity and the risk. And from there, a couple years later, our first hire was an acquisitions analyst. I think that's a very typical first hire because it's one of the first parts of the business that becomes essentially time consuming and repetitive. And I wouldn't say it's low value. It's definitely high skill, high value. But if you're trying to lead and grow the company, you shouldn't be spending your time in the spreadsheets all day. So that was our first hire, and that allowed me to free myself up so I could spend more time on growing the business rather than, sourcing deals and crunching the numbers.
And how did you and your partner split up your roles?
So my roles initially were focused on acquisitions, which then bringing in the acquisitions analyst, of course, obviously helps me in that department, and then also for me, marketing and investor relations. So I was basically kind of like between brokers and investors, the face of the company, and then also, of course, kind of guiding the acquisition strategy. And then my business partner was overseeing operations, which include, and that at that time, when you're starting out, you don't have a big portfolio, so there's not a ton to operate, but there's still a lot of things going on between transaction, transaction coordination, legal, accounting, property management, asset management, and at that time, investor relations or the investor reporting was kind of more so sitting in the asset management side of the house. Today we have obviously a much bigger team, so we have three asset managers with an asset management analyst, and that team puts together the monthly reports for investors, and then those reports go to the investor relations team, and then we have three, four people there who review those and kind of clean them up and make sure that they get delivered to investors properly.
It's interesting, right? So, how do you nurture a relationship with your with investors, right? So, investors come in through a variety of different ways. You go to events, you're speaking, you got some lead magnet, they're coming in, they're, whatever, they're filling out a form or whatever. How do you guys, what is your process for, nurturing those relationships to the point where they eventually invest? Because they'll come off a Facebook ad, they look at you, it's cool, here's 100 grand. At least that used to happen that way, right? It happens a little less right now. But then others, they'll stay on your list and they'll watch and then watch, and eventually they either go away or they invest. But what do you guys do to nurture those relationships?
Yes, you threw out a lot of really powerful stuff, and I think when you're getting started on the marketing side, that could sound very intimidating. If I told you, hey, in order to raise capital from investors, you need to have a YouTube channel, you need to have a podcast, you need to do a newsletter, and you need to be on Facebook and LinkedIn. It's like, whoa, this is insane, right? So my thought and my recommendation is if someone's looking to get started on the marketing side of things, it's basically just pick one thing and do it well. And that could be a written newsletter, it could be a video series on YouTube, or it could be, an audio only podcast. Whatever it is, you just want to focus on that and make it good because whatever you do is not going to be good at first, right? But you focus on it, you make it good, and then you can repurpose it and syndicate it out to other things, right? If you're making content dedicated for LinkedIn, that content will probably do just fine on Instagram as well when you're getting started. So for me, it was a similar path of kind of my first interest was writing. I like to kind of think and write and get my thoughts out on paper. And so I started sending out a monthly newsletter. That monthly newsletter became somewhat popular, I would say. And that helped attract more investors. And then kind of adding on, okay, well, let's do some YouTube videos, let's do some podcasting, and so on and so forth. And then you mentioned a big piece, which is a lead magnet. That is a game changer. Having a lead magnet where you're actually enticing people to want to give you their email, have a phone call with you, join your ecosystem, all that is you know, basically table stakes, right? From there, that's where things get interesting because you might have an amazing phone call with a potential investor, but it might just stop there. And so we're very intentional about making sure that we put a lot of effort and time and money into a potential investor lead. So I don't want to just have a good phone call one time and leave it at that, right? I want to make sure that we're following up. I want to make sure that we are really figuring out what their needs are. Maybe they're interested in 1031 exchange. Maybe they're interested in a short-term investment, which is really not what we offer. So we kind of, you know, push that in a different direction. Or maybe they're interested, maybe they're super interested in what we do. So we make sure that, hey, we'll call you next week. We'll call you the week after, and we'll stay in front of you. To your point, it's been a very difficult time in the market over the last few years, and when it comes, so for example, we were quite busy in 2024. We closed 5 deals, and so when you're closing deals back to back, it's a really great way to stay in front of investors because you
Ah,
have something to talk to them about, right?
right, right.
Right now we haven't closed a deal all year, so it's been 6 months. So it requires an extra level of effort and I would say creativity to stay in front of investors and provide value. Because if we're not pitching them a deal, it's like, hey, let's go out to dinner. We're gonna host an event where we talk to you about this strategy. Or my sister Dasha, our director of investor relations, she just published a book about 1031 exchanges for syndications. Very cool topic. So, our office assistant right now is busy writing handwritten notes and shipping out this book to a bunch of our contacts. So it's just finding creative ways to stay top of mind.
Yeah, that's very, very interesting. Have you considered, so it's interesting, right? Because deal flow has been a bit of an issue. Have you considered or have you maybe raised money for other operators at all to keep your investors engaged, or have you kind of stayed away from that?
We've stayed away from it. I think that's tempting. We've got people on the
It's
team who
tempting.
say, hey, let's raise a debt fund or let's do this or let's do
Hmm.
that. And I think my that could work and that could be smart, but I always go back to my long-term vision. I think, okay, 30 years from now, what do I want to be remembered for? What do I want our business to be known for? And I really want our business to be known as that old, boring business that does the same thing over and over again, and they do it really well. They don't get ahead of themselves and you know, kind of get over their skis. So I just bring it back to the long-term vision. So it might suck now to, not really have much going on the investor raising capital side of things. But long term, it's going to be totally fine.
Yeah, that's right. What's kind of been your biggest challenge over the last few years from running a syndication operation?
Well, far and away, the last few years have exposed the challenges of operations
Mm,
because, and you can bring up the Warren Buffettisms of, when the tide goes out, you can see who's swimming naked, or, uh, basically an up market makes everyone look like a genius and your sins are washed away. But when the market is flat, not even necessarily down, which it has been, but even if the market's only flat, now it really exposes, are you a good operator? Are you the one creating value or is it just the market? And so when we've been in a down market for the last few years, you are swimming upstream. And so your operations have to be that much better just to tread water. So it's been a huge investment in our company to really redefine what it means to be a good manager of apartments. And so that included actually a stint last year where I moved down to Houston and I lived at one of our properties so I could immerse myself in operations, really meet all the people, understand how everything was working. And we've really made amazing strides just by putting in the effort and, not seeing the market just go up and up. So I think it's really a blessing in disguise because we're building such an amazing foundation for when the market does reset and valuations and rents and everything are going up and up again, we're going to be that much better equipped to take advantage of the opportunity.
I think it is a blessing in disguise. It is nevertheless painful. It's just we have the same thing. I mean, operations have been a real challenge, and and we have made a lot of changes and pivots in response to it. And it's a slow moving slog. It's like it's so slow moving, right? But we're constantly getting better, slowly getting better, and it has exposed a lot of shortcomings that weren't there before in a market that's going up. So it is a blessing in disguise. On the other hand, because of it, I think we have been slower to grow because we've had so much operational stuff to focus on that has really prevented us from really growing more aggressively. But it is kind of a blessing in disguise because if the wheels are half off and you just kind of throw, fuel on the flames, the whole thing's just going to explode. And so it is probably back to your point, sometimes better to go a little slower and build a stronger foundation before you can move forward. What are you excited about moving forward?
Well, I'm just really excited about every day. To your point, operations is a slow burn, right? It's very different than the investor relations business and the acquisitions business. In the acquisitions business, you get a deal awarded, you put it under contract, you close it. These are champagne moments. These are big wins. And similarly, on the investor side, if meet a new investor and they want to invest $1 million with you or $5 million with you, it's like, wow, that's amazing. That's a huge win. Operations is a very different game. It's every day a win, every day a loss, and you just keep working at it. So I'm just excited to uh, just keep on the path that we're on. I'm very confident that if we just continue to put one foot in front of the other, we don't have to reinvent the wheel. We just keep doing what we're doing. We're going to see amazing results. And I think, like everyone else in our business, we're looking forward to the days of interest rates and the market and sellers making a little more sense so we can just kind of get to business. We're not looking for 0% rates necessarily, and we're not looking for, the market to get overheated like it had been, but just a nice stable market where we can continue to grow. I'm just super looking forward to that.
Yeah, and are we going to get a stable market, or what's in your looking glass there for that?
Yeah, my crystal ball is really, as usual, broken. So I think everyone's crystal ball is broken right now. It's really tough to say with the uncertainties associated with tariffs, interest rate policy. The bond market is saying one thing, Fed saying another thing, and so on. So I've been kind of holding strong to the belief that the economy is weakening, and it has been for the last few years. And when I say weakening, I'm not being super negative. I don't think, oh, big recession, depression, that sort of thing. But one of the positives associated with weakening is a reduction in inflation. And if you look at kind of the most recent numbers, inflation has really calmed down substantially to the point where I think that, and of course, this is self-serving as a real estate guy. I think the Fed is totally behind the eight ball when it comes to lowering rates. I think th inflation is not the main challenge of the economy, and I think rates are substantially restrictive at the moment. However, Jay Powell has a very difficult job, and I think at the same time they're looking at the one-time shocks potentially associated with tariffs, and they're just looking at the job market. Labor market is, resilient, as they like to say. It is until it isn't. And so I think what's going to happen is basically the Fed's going to hang on to rates where they are as long as they can until the economy looks it breaks or it looks like it's breaking, and then they're going to cut fast. And that's just kind of how history goes. It's like everything's fine, and then bang, rates start coming down fast. So I think we're going to see that happen over the next probably 12 months.
Rob, how can people connect with you?
To learn more about myself and our company, Lone Star Capital, you can head to our website, lscre.com. On our website, we've got awesome resources, free download of our underwriting model, link to the books that we've published, and ways to get in touch.
It's been awesome jamming with you here today, talking about scaling in real estate, my favorite topic. So, Rob, thanks for being on the show today.
Yeah, thanks a lot for having me.
I kind of find it fascinating the mindset with how people approach real estate in general, right? So Rob is one of those guys who, from the beginning, what he said is he really approached it from a scaling mindset, and that changes everything, right? Because how you approach it changes everything, and a lot of people have more of a single family house investing mindset. So, for example, you can buy a duplex with a single family house investing mindset, and the next one you're going to buy is going to be a duplex or a single family house, right? A scaling mindset, even if you were to start with a duplex, for example, you're not going to do a duplex again. You'll probably do a fiveplex. Okay. And when you do it, the third deal is going to be more like a 10 or 15 unit, right? The deals keep getting bigger because you approach the business with a scaling mindset. It's the same thing here when you get into syndications. I see a lot of people, they really focus on the first deal and then they just do a second and a third. They don't really think about what does it take to scale. Now, in our students, we try to change that. We focus them like a laser on that first deal, but as soon as they close that first deal, we're talking about scaling because with a scaling mindset, you're going to do different. It alters your behavior of how you do things. And Rob talked about that. He's like, okay, how do I do this? I'm strong in this way, and I'm more outward facing, and I'm not really that good at operations. He understood that. So if he wants to scale, right, he needs someone to do the operations side. So he brought on this business partner, and then he was like, okay, I really this analyzing thing is very tedious, so I'm going to bring on a junior analysis person to do that, or a VA, a virtual assistant, something like that. So people who are scaling are always looking for how they can do more. They do more by essentially doing less. So they're bringing in income. How do I reinvest that income to build a team so I can do more without without me, sacrificing my quality of life? And so people ask me, when is enough enough? And the answer really is, well, I don't know, right? Because it's not really enough being enough. It's like, if I can grow the company without me having to do more work, then I'll just grow the company, right? But what a lot of people do is they grow the company, they just keep doing more and more work because they feel like they need to do everything themselves, and the only way to do more, to achieve more, is to do more. And that's really a limiting belief for people that do not have a scaling mindset. Rob obviously does not suffer that problem. So what I'm saying is, when you're approaching real estate, really approach it with a more of a scaling mindset. Really study what it's like to scale with real estate, because people who invest in single family houses, either rentals or even STRs or flips, they're not really scaling. It's very difficult to scale those. You really think about scaling, right? How do you actually get to $10,000 per month in income with these strategies? And it's very difficult, right? It's not really very easy to do that. Where syndications, you can scale very quickly with just one or two deals, and now you have the income coming in where you can afford to hire a team as well. Now, one of the things I thought interesting when Rob talked about is this, what he would have done differently. And it's interesting, he gravitated to those things. He gravitated to me. When I do that with myself, the first thing that I go back to is, man, I should have had a scaling mindset earlier on. Like, I should have learned to build a team. I should have learned to partner. I should have learned to bring in advisors, which I did not do. And as a result, I struggled. I struggled, especially when I got into multifamily, because I took my single family house investing mindset and tactics that used to work, like doing everything on my own, or figuring everything out my own, or trying to know everything I need to know, or having my own money, my own resources. And when you go into a scaling mindset, when you get into syndication world, right, it's totally different. If I don't know something, I'm going to find someone who does. If I don't have something, I'm going to go find someone who does have that thing. Right. And this is why I build a team of professionals. I have my property manager I can lean on, my lender I can lean on, my SEC attorney I can lean on. I will now start looking for partners. Right. So if I'm more of a deal finder person, then I'm going to partner with a more of a capital raiser type person. Right. If I'm more of an external type person, like Rob, more of a visionary, then I'm going to partner with more an internal operations kind of person. And I'm also going to surround myself with advisors, people who are very experienced at doing what I want to do. And this is the thing I've learned over like probably the last 15 years. But when I first got started as an entrepreneur in 2005, I did not understand that, because I was smart, and perhaps I am, but it takes too long to acquire the knowledge yourself to learn those things. And that's what I did. I did a little bit of what Rob did, and just kind of did one thing after another. That didn't work. I tried something else. When in hindsight, I could have just sat down with someone who had 1,000 units and go, okay, how'd you do it? Give me the playbook. Right. And I would have cut off years of misery in trying to figure that stuff out. So in your own journey to scaling with real estate, I really encourage you to build your team, your professional team, to partner, and then also to surround yourself with experienced people. And we'd love to be that person on your team, because we offer mentorship on the training side as well. And so take a look at that. Don't do this alone. It's too tedious, takes too long, and it's no fun. Right? There's all these things you got to learn, and it just takes too long to do. So check us out. The best place to go after this podcast is thefreedompodcast.com. It's kind of the next step from the podcast. So if you want to become a GP, there's Apartments 101, an hour-long training that introduces you to syndications as a GP. If you do want to explore mentorship, you can also book a call with us and explore that as well. If you're more of a passive investor, we talked about here on the call with Rob, you're like, okay, I'm a high-income earner. I don't want to exit what I'm doing right now, but I do want to invest passively in real estate, then have a conversation with us at Nighthawk Equity. And you can, this launching pad is all on thefreedompodcast.com. You can book a call with us there as well. Love to get to know you. But we also have a course on what it's like to invest passively in a syndication if you're new to that as well. So a few resources for you as a next step here to this episode. Hope you got some value from Rob and were inspired to get into this business. I think it's super exciting how scalable this business is, and hopefully you'll follow in Rob's tracks here. All right, I'll catch you next time.